Hey, deep divers. Ready to dig into something really interesting?
You bet.
So we're talking gold today, right? Everyone wants to know, what's driving the price?
Hmm.
Especially with how crazy the markets have been.
Yeah, especially lately.
Exactly. Well, get this. We've been deep diving into a ton of research. And the connection between gold and U.S. Treasury bonds, wow,
It's way deeper than most people think.
no kidding. Actually, did you know that gold's price surge? It started way before the 2007 crisis.
Oh yeah, years before. Like, we're talking years.
Right. And we're not just speculating here. We've got charts.
Visuals. The research has it all laid out, gold's performance compared to, say, the S&P 500 over the past 2 decades.
And the difference is striking. You can't miss it.
This suggests it wasn't just people panicking, like a knee-jerk reaction to the market. Something else was going on.
Deeper forces, huh?
Deeper force.
Okay, so basic stuff, gold is seen as this safe haven asset, right?
Right.
People flock to it when inflation is high or the stock market's tanking.
That's the classic narrative. And research backs it up. Barr and Lucy, McCown and Zimmerman,
Oh yeah, I've seen their work.
they've shown that gold, well, it tends to hold its value even when things go south. Good for diversification, hedging against risk.
Smart move.
Oh,
But this deep dive, it's suggesting there's more to the story than just that.
yeah.
Here's a curveball. Emerging markets, like Brazil, India, China,
Big players.
huge.
Yeah.
They saw a similar boom and bust pattern during this time, just like gold.
That's where it gets interesting. It makes you think, what if they're both reacting to something else, some hidden connection?
Okay, now I'm really intrigued. Spill the beans.
All right, so researchers use this method called Granger causality, basically. It helps you spot cause and effect relationships.
Like, instead of just correlation.
Exactly, like a roadmap for how things influence each other over time.
I'm with you. But how do you even begin to untangle all those threads? Financial markets, that's a whole web of stuff going on.
Right, it's complex, but that's where this visual tool comes in, the time series causal model graph. TSCM, for short. Basically, it's a map shows how changes in one thing can ripple out, affect other things.
So the TSCM is like our cheat sheet.
Exactly. Helps make sense of how all these financial factors are related.
Love a good cheat sheet. Okay, so nitty-gritty time. What did this deep dive actually reveal?
Well, researchers started with 2005 to 2006, right before things went haywire in 2007. And what they found, well, it surprised us.
Let me guess, gold went up because the stock market was shaky. Classic safe haven move, right?
You'd think so, wouldn't you? But the TSCM, it tells a different story.
Oh, really?
The biggest driver for gold prices during that time, it wasn't equities.
Whoa, hold on. You're telling me it wasn't the stock market?
Nope, not at all.
Okay, now I'm dying to know. What was it then?
It was U.S. Treasury bond yields.
Bond yields? You mean like the interest rates on those bonds?
Specifically, those with maturities of 7, 10 years and 20-plus years.
So you're saying that those interest rates, they had a bigger impact on gold than the stock market did, even before the crisis hit?
That's exactly what the analysis shows. And they double-checked. Researchers built a pure forecast model to be extra sure.
A double-check system.
Yeah.
I like it. So what happened?
Forecasts were spot on, especially for gold. It really lends credibility to the idea that those bond yields were a major force.
So even before the crisis, interest rates were already telling a different story, not the usual stocks down, gold up thing.
Right, something else was at play, which is what we're going to dig into more in part 2.
Okay, you got me hooked. We've got this unexpected connection between gold and U.S. Treasury bond yields. But how does that even work? Like, what's the mechanism there?
That's a great question. And that's exactly where we'll pick up in part 2 of this deep dive.
All right, deep divers, hang tight. We'll be right back to explore the why behind this fascinating connection.
Welcome back. Last time, we uncovered this pretty unexpected link, right?
Between gold and U.S. Treasury bond yields. Yeah, that was a surprise.
Even before the 2007 crisis. So now we're going to unpack that. Like, how does that connection actually work?
Okay, I'm ready to go deeper. You mentioned ETFs, how they were used to track all the market movements. Can you remind us what those are again?
Sure. An ETF exchange-traded fund, it's like a basket of assets.
Meaning a mix of stuff.
Exactly. Stocks, bonds, you can even have gold in there. And you can buy and sell shares of that ETF right on the stock market.
So it's like one-stop shopping for investors. Instead of buying all those things individually, they can just get a piece of the whole basket.
That's it. And the researchers, they looked at ETFs that tracked gold, U.S. Treasury bonds, S&P 500, all the major players to see how they all interacted.
So by watching how those ETF prices moved, They could kind of figure out which forces were really pulling the strings.
Exactly. And one of the key things they notice, changes in those bond yields. The interest rate you get on a bond, that seemed to have a big impact on what investors were doing.
Okay, but I'm still not quite getting how that translates to the price of gold.
All right, so imagine you're an investor. Bond yields are really low, right? That means you're not making much money by lending your money to the government. So you might start thinking, where else can I put my cash? I need something with a little more oomph, a little more growth potential.
And suddenly, gold's looking pretty good.
Exactly, because gold is known for holding its value, right? So if those bond yields are low enough, gold starts looking more and more appealing, even though it doesn't pay interest like a bond does.
It's like they're on opposite ends of a seesaw. When bond yields go down, gold's appeal goes up.
That's a great way to put it. And you mentioned earlier inflation expectations, right?
Yeah.
Especially in uncertain times, yeah.
Because when people are worried about inflation eating away at their savings, they look for assets that tend to hold their value. And gold has always been that safe bet.
Right, even though gold doesn't pay interest, it's that perceived stability that makes it so valuable when everything else feels shaky. And the researchers saw this play out, especially during the 2007-2009 crisis. They used an ETF that tracks inflation-protected U.S. Treasury securities. So those are the kind that adjust their payout based on inflation. And what they found was that changes in this ETF, they were closely linked to gold prices during that whole turbulent period.
So it's like a double whammy during a crisis. Low bond yields and fear of rising inflation. Gold suddenly looks really, really attractive.
Exactly. But there's another piece of the puzzle here, and that's currency fluctuations. We have to look at that USD/EUR exchange rate.
Yeah, we touched on that earlier. How does that fit into all of this?
Well, during the 2007 crisis, the US dollar, it was seen as a safe haven currency. Investors all over the world, they wanted dollars.
Because they were seen as more stable.
More stable than other currencies, like the euro.
So that demand for dollars, it drove up the value, right? Like a hot item, suddenly everyone wants it, so it becomes more expensive.
Exactly. And when the dollar gets stronger, it makes gold, which is priced in dollars, more expensive for people buying it with other currencies.
So if you're in Europe and you want to buy gold, suddenly you're paying more euros to get the same amount, just because the dollar is strong.
That's right. It all becomes about relative pricing. A stronger dollar can actually dampen demand for gold and put downward pressure on the price.
So we've got these three big players all tangled up. U.S. Treasury yields, inflation expectations, and the USD/EUR exchange rate. But the craziest part to me is that researchers didn't just observe these connections. They built models that could actually predict gold's price based on these factors.
It really shows how powerful data can be. Like, we can use it to understand these hidden forces shaping our world. And what's even more amazing is how accurate their pure forecast model turned out to be, even during a crazy time like the 2007 crisis.
It's like peeking into the future of the gold market. So what does all this mean for someone who's trying to figure out gold prices today? Like, what should they be watching?
It shows us that it's not just about emotional reactions, following the crowd. We have to look at these key drivers, those U.S. Treasury yields, inflation expectations, how strong the U.S. dollar is. That can give us real insight into what's moving the price of gold.
And let's not forget, those U.S. Treasury bond yields, they were a major factor even before the crisis hit. This isn't just about the crisis. It seems like a more fundamental link between gold and the bigger economic picture, interest rates especially.
Absolutely. And that brings up a really interesting question. We've seen how gold reacts to low U.S. Treasury yields, in those years leading up to the 2007 crisis.
But what happens when those yields go up? Like, what does that mean for the future of gold? I guess we'll have to wait for part 3.
Stay tuned, deep divers. We'll be back to wrap up our gold exploration.
Welcome back, deep divers. It's been quite a ride so far, hasn't it?
It really has.
We've been exploring all these hidden connections, gold, U.S. Treasury yields, inflation, even how currencies move against each other.
A lot to unpack.
Definitely. But the million-dollar question is, what happens to gold when interest rates start going up?
Yeah, that's a big one. Especially with all of the central banks hinting at rate hikes, they want to get inflation under control.
Right, makes sense. So if low interest rates were good for gold back in the early 2000s, does that mean rising rates would be bad news?
Well, you'd think so, wouldn't you? But gold's not always that straightforward.
Right, because even if bonds start looking better with those higher yields, Gold still has that safe haven thing going for it.
Exactly, that stability factor, especially if those rising interest rates, if people start worrying about a recession or if inflation just won't quit even with the hikes.
Yeah, then gold starts looking pretty good again.
It's a tough call for investors, trying to balance those potential bond returns against gold's safety and inflation protection.
So it's not as easy as saying rates up, gold down. There are other things at play.
There always are. Think about those emerging markets we talked about. They often have to deal with higher inflation, more economic ups and downs, compared to developed countries.
So for investors in those places, gold might still be super important to them.
No matter what interest rates are doing elsewhere.
Yeah, they might see it as that extra insurance policy against all that uncertainty.
Right, and we can't forget about the psychology of it all. I mean, gold has held this power for centuries, right?
People just have this deep-rooted idea that it means wealth. Stability.
Exactly. And that perception, it can really drive how investors behave, especially when things look a bit murky economically.
So even if rates are rising, any kind of geopolitical tension or fears of a global slowdown,
Boom, everyone runs to gold. That flight to safety drives up demand.
it all comes down to how people see risk and reward
Right.
in that bigger picture of what's happening with the economy and geopolitics.
Exactly. It's all connected. Which reminds me, you mentioned that George Bernard Shaw quote earlier about choosing between gold stability and trusting the government. Even back then, he saw gold as that ultimate source of security.
Yeah, it really speaks to how powerful gold is. Even with all our fancy financial tools, gold still holds a special place in people's minds.
It's timeless.
Totally. So higher interest rates might make things a bit tougher for gold, but it's definitely not the end of the story.
Not at all.
Gold has these unique qualities, that enduring appeal. It suggests it's going to remain relevant, no matter what happens with interest rates.
I agree. And remember, this deep dive, we've focused on the economic side of things.
The fundamental drivers.
Right. But there are other factors, too. Supply and demand in the physical gold market, for example. That plays a role, too.
Always good to remember that the world's a complex place. It's not just about theories. It's about understanding how things actually work out there in the real world.
Exactly. That's why these deep dives are so fascinating, exploring all these intricate connections, seeing how it all comes together.
Well, deep divers, I think we've reached the bottom of our gold mine for today.
I think we have.
We hope you've come back up with a better understanding of what makes gold tick, whether the waters are calm or a little rough. And as always, keep exploring, keep those questions coming, and keep diving deep.